love with you, girl, you know you're my baby. You know, I load up my guns, you know that I'm crazy. I load up my guns, you know that I'm crazy. I'm sorry, girl, for making you crazy. But you know that's how I like it, yeah. And I love it when you ride it, yeah.
Hey man, that song be getting me lit. My bad, y'all. Hey, what's good, y'all? What's poppin'? I'm back talking about stock options. You feel me? Let's get it. I know y'all read the caption, and today we talking about them Greeks. And speaking of Greeks, you see I got my Michigan State flag up. Not today, man. Let's get it. You feel me? I had to go ahead and switch my flag up, you know. Hey, man, shout out to them brothers of Iota Phi Theta Fraternity Incorporated, man. But today I'm be teaching you guys all about the Greeks, you know. Not those Greeks, but the Greeks that affect the price movement of your option contracts, all right? Now, I know you probably seen Greeks around on Robinhood, and I know they probably seem a little intimidating, or you probably just haven't had the time to research them, all right? Boom, bam, that's what I'm here for today. I'm gonna keep it basic and simple as possible. I'm gonna throw some stuff up on the screen. You know how I do. I'm gonna explain that, and then we're gonna go ahead and hop in Robinhood. I'm gonna show you guys what all of these Greeks have to do with the option contract price movement and how you can use these Greeks to choose better option contracts to boost your risk and reward, all right? So we're gonna go ahead and hop into it. Let's get it. All right, first one up we got is Delta, all right? Now, Delta may be one of the most important ones of them all because it tells us how much money we're gonna make, potentially, and how much money we're gonna lose, potentially, on our option contract, all right? Now, Delta measures the rate of change of an option contract or option price relative to the changes of the underlying asset price, all right? Now, I know that might sound complicated, but all of that means is that for every $1 price movement of the stock that you got in, Delta tells you how much money you're gonna make or lose, all right? So if you got into a Microsoft option contract, for example, and you had a delta of 0.50, all right? For every dollar movement of Microsoft, you're going to make $50, all right? So if Microsoft went up from 250 to 251, you're going to potentially make $50. If Microsoft goes down from 250 to 249, you're going to potentially lose $50, okay? Now that's all the delta means. Delta is measured from 0 to 1. So the further you get in the money, the more delta you will see on your option contract, all right? But they will be more expensive. The farther you get out of the money, the less delta you will see, but they'll be a lot more cheap, but a lot more risk, okay? So that's all the delta means, to break it down simple. And we're gonna go ahead and head on to that next one, all right? All right, next one up we got right here is gamma, all right? Now, it's only right to do gamma after delta because our gamma affects our delta, all right? Now, I know we're gonna go ahead and read the definition. It's gonna sound a little complicated, but I'm gonna break it down for y'all, all right? So, gamma measures the sensitivity of the option delta to the movement of the underlying asset price. It sounded complicated to me when I was just reading it, but all it does is for every $1 price movement of the stock, is either added in to your delta, and for every $1 price movement down, it's taken away. So it basically just affects the price of your delta, and I'll show you more about it when we get into Robinhood, all right? All right. Now we're gonna talk about that big one, man. We're gonna talk about that one. The one you always hear about, we're gonna talk about that one. All right, now we got theta, right? All right, so theta has everything to do with time decay and the expiration date of your option contract, all right? So it measures the rate of change of the option price relative to the change in time left, all right? So basically that means as time goes on, theta will wear down on the price of your option contract, all right? So every time a day goes by, you'll lose money in your option contract from the theta, all right? So if your theta is 0.17, tomorrow you'll lose $17 if the stock doesn't make a move, okay? That's basically what theta is. It's just a time decay and a wear down on your option contract, just to keep it simple, all right? All right, and last but not least, let's go ahead and talk about Vega, right? So Vega is basically the rate and change of the option price relative to implied volatility, right? Now, I know you're probably thinking like, man, what in the world is implied volatility? Or don't worry, right? That's why I'm here. Implied volatility is basically the measure of how the stock is moving at that time, all right? That's all it is. And traders basically use implied volatility as a benchmark for risk. It just helps you measure out your risk and reward when you choose an option contract. But don't worry, I'm gonna show you about all of these Greeks and what it has to do with all of your option contracts in our example on Robinhood. So let's stop talking about all of this and we're gonna go ahead and get straight into it, all right? Let's get it. All right, guys, we're finally gonna go ahead and hop into Robinhood.
Now that we are here, I'm going to go ahead and show you guys what these Greeks have to do with the price movement of your option contracts and what it has to do with you making or losing money, all right? So we're going to go ahead and hit that magnifying glass at the bottom of the screen, and we're going to go to the top and search the SPY index. You guys know I love trading SPY because they price their option contracts very well. So let's hit that trade button at the bottom of the screen and then the trade options button. We're going to look at the top of the screen at the expiration dates. Let's go ahead and choose the June 1st expiration date, all right? Looking at the screen, let's go a little bit out of the money and choose the 421 call. Now, on this screen, on the left, you'll see that Robinhood has the bid and the ask price highlighted in green, right? Now, there's a little arrow next to that you never really pay attention to, but today we're going to finally hit that arrow, all right? Now, on this screen, it pulls up your stats and, of course, what we've been talking about today, your Greeks. All right, so for this call option, you will see that we have a delta of about 0.36, right? So that means for every $1 price movement of SPY, you'll be making about $36 or losing about $36. So for example, if SPY goes up right now from $419.75 to $420.75, you'll be making $36 on this option contract. Now, if SPY goes down from $419.75 to $418.75, you'll be losing about $36 on your option contract, right? Simple enough, all right? So now we're going to go ahead and look to the right of delta and we'll see our gamma. Now, as you can remember from earlier, our gamma has everything to do with our delta. So for every $1 price movement up of SPY, you can go ahead and add that gamma into your delta. So right now our gamma is 0.10, which is about $10. You can add that $10 into your delta, which will make it $46 that you will be making for every $1 price movement, and vice versa. So you can subtract that $10 from your delta for every price movement down by $1 of SPY, all right? Simple enough. All right, so now if you look below delta, you'll see that we have our theta. Now our theta is negative 0.13, which is about $13. Now, if you remember earlier in the video, theta is all about time decay and the wear and tear on your option contract. So for every day that the market trades flat or doesn't make a move toward the price of the option contract that you bought, you're going to be losing about $13 on this option contract, all right? Now, most traders try to avoid theta and time decay by doing spreads and other techniques, but we'll definitely talk about that in other videos, all right? Just make sure for this video that you pay attention to your delta to theta ratio when you're doing straight up calls and puts, okay? And then we have Vega, right? Now remember that Vega has everything to do with our implied volatility. So if you look up at your stats, this is where you will find your implied volatility for your option contract. Now our Vega is about 0.17, which is about $17, right? Simple enough, it just means for every 1% move of our implied volatility, you're going to be adding $17 to the price of your option contract or taking away $17 from the price of your option contract, all right? Now, it is imperative to understand implied volatility when it comes to option trading, all right? Because it can determine if you're getting a good option contract or a bad option contract, or if you're choosing an option contract at the wrong time, all right?
All right, man. So I hope this video helps some of you guys out understanding the Greeks and what it has to do with your option contracts and which ones you should be buying and which ones you shouldn't be buying. How much money you're going to make on these option contracts and how much money you could potentially lose, all right? Now, with all that being said, man, until next time, remember, man, don't trade stress and always stay blessed. These rhymes I'm coming up with, these is fire. Y'all gonna fall in love with these, man. All right, y'all.